Hello, this is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. And one thing I've noticed here is that people are very antsy today. Now that the market's rallied a little bit, a lot of people are getting afraid that the stocks may fall back again, and therefore they're selling out of their portfolios when we believe stock prices are extremely low. So my objective today is just go through a group of what I consider to be very strong, high-quality companies whose business results have held up or in many cases even increased during this recession, but whose stock prices are clearly on sale. We're going to use our fundamental research analyzer tool to illustrate that. The first example here is a picture of Danaher. I want you to notice that this company's earnings growth has been very, very consistent. Even with the forecast of a slight drop in earnings, their stock price over this entire 16-year period has traded at or above its earnings justified growth rate. Now we see the stock price is extremely low, and even though it's rallied very strongly, it still has a long way to go. This company is on a historical basis extremely undervalued in our opinion. Second example is Fiserv. Once again, I want you to notice the company has had consistent year after year after year earnings growth. The stock price is the black month. These are monthly closing stock prices. The black line. The stock price has never traded below this earnings justified level. We had the recession. Fiserv continued to generate strong results. Their stock price got low, and even though it's recovered very strongly, it's still trading below its earnings justified level. This would normally be a stock trading in the mid-60s. It's currently at only $46 a share. Next, I have Aflac. Exactly the same story. This company's raised their dividend. They pay a very attractive dividend, over 3%. The stock price got extremely low at under $17 a share on fear. This company has almost gone up 100% since the beginning of the year and is still trading at a significant discount to what would normally be a $75 price. A great company on sale, and yet still a lot of room to go. Next, we have Stryker. Once again, we see impeccable earnings growth year after year after year, over 20% a year earnings growth. The stock price is mostly sold at a premium to its earnings justified level. This is the only time in the 20-year period that the stock price has been below its earnings justified level. And even though we've had a modest rally, another company that has a long way to go. My next example is Coach, a little more growthy. Obviously, this is a premium brand women's handbags. The company's had earnings growth of over 37%, has no debt on the balance sheet. As you can see, their stock price tracked earnings very close to their earnings growth rate. They've normally traded at around 27 times earnings. They currently trade at 14 times earnings. The stock got excessively and massively overbeat up in our opinion. It should have never gone this low. It should have never gotten below, in our view, $50 a share. It's currently trading at 27, and even after this nice rally, it's still on sale. Here we have Google, incredible growth. Obviously, normal price earnings ratio around 35 or 40, trading at 25 times earnings currently. Even though it's rallied off of its low, this company still has room to go. It's still a extremely high quality growth stock on sale. No debt on the balance sheet, very attractively. Next example, a very growthy company, GameStop. The stock is trading significantly below its normal price earnings ratio. It trades for less than 10 times earnings, grows over 30% a year, and has continued to grow right through the recession. Another example of a company with a very healthy balance sheet that's trading at a ridiculously low valuation in our opinion. This company should be trading in the 40s. It's trading in the low 20s. Next, we have another very fast-growing stock, Cognizant Technologies. Look how the price correlated to earnings over this period. The market really beat this stock up. If anything, they had a little temporary slowdown in earnings, but they actually increased earnings right through the recession. The stock has rallied nicely from its low of around $17 a share. It's already trading at 27. But again, another example of a company with no debt that has a long way to go. National Oil Well Varco, a great way to energize your portfolio. You can see the stock price is correlated very closely to their operating results. We had the fall in oil prices. The stock fell like most companies in the oil service business fell. It got dramatically underpriced. Even though it's had a nice recovery, oil, as you might have noticed, is jumped up over $70 a barrel again today, and this would be a great long-term opportunity as an energy play. Here we have PepsiCo, a nice 3.1% dividend. As you can see, this company has historically traded at 20 times earnings or better. This is the first time, or only the second time, I should say. The other time was in 1994, which would have been a great buying opportunity for Pepsi, where the price has traded at such a low valuation. Great dividend, what Peter Lynch referred to as a stalwart. Another example of a great company on sale, but still a long way to go. At normal valuations, this would be a $70 stock, and you can buy all the Pepsi you want today at 53 with a nice dividend to reward you while you're waiting. Well, there you have it, a nice cross-section of some really terrific companies that have stayed strong throughout the recession. These are really good businesses on sale. They're too cheap to be selling here. They all should be bought here, in our opinion, because the long-term rates of return from here are extraordinary. When companies are low that is the best time to buy them. That's obviously common sense. When companies are overvalued, those are bad times to buy them. Most of the losses that we've suffered, as I mentioned in the blog, written portions of the blog, have come from overvaluation. Stocks are cheap today. This is a great time to becoming aggressive. You can buy some terrific companies on sale. This is Chuck Harnevale saying, hope this gave you a nice perspective of today's market and the current level of valuation. Look forward to talking to you again tomorrow. Thanks for